I need some traction. You need some traction.
Hey everyone, Lloyd Lobo here, co-founder at Boast AI and Traction. Today's Traction webinar is brought to you by Boast AI Launch Academy in partnership with Growth Blazers. Super exciting topic today. There's a lot of money in the market, and it feels like hundreds of millions of dollars are being funded at every minute. And every company we know is raising hundreds of millions of dollars, and it seems easy, but I don't think it is as easy because I still know a ton of companies that haven't been able to raise. And so today we've got two experts. We got Adam, founder of Ledn, that raised a $30 million Series A, and Alex McIsaac, partner at Global Founders Capital. And he's invested in 20 plus deals in the last year alone. So they're going to tell us about the top themes in VC that are driving startup funding and fundraising best practices for 2022. And if you guys have any questions, if you folk have any questions, type them in the Q&A tab. We'll take them as we go along. And don't be shy. Feel free to introduce yourself in the chat. Introduce yourself to everyone, not just hosts and panelists. Introduce yourself. What's your company do? What's your name? Where you're tuning in from? And if you have any questions, drop them in the Q&A tab and we'll take them at the end. So guys, Adam and Alex, welcome to Traction. How you guys doing?
Doing awesome. Thanks so much, Lloyd.
Well, Lloyd.
Awesome. Fantastic. So, before we dive in, you guys have had a fantastic career. Walk us through your backstory and maybe Alex, like how did you get into investing with GFC?
Yeah, for sure. So I started out in venture and startups about 10 years ago. Graduated from Western, from business school there, and started in venture, but quickly kind of left to become an operator, helping found a company in the clean tech and lithium-ion battery space. It was actually kind of during that journey as an operator where I met Adam, and he was actually on the investor side of the table, and I was an operator. And so over the years, our roles have switched, but we ended up selling that business to Blackstone in 2018 and joined BDC Capital, and then joined Global Founders Capital about 2 years ago to lead up the Canadian seed practice here. Been active.
Awesome. Tell us more about Global Founders Capital, more about the fund, what kind of companies you guys invest in, why take your money? Give us the pitch.
Yeah, for sure. So overall, European fund, about $3 billion under management across two large life cycle funds. We're all investing out of the second fund now. We kind of have this decentralized partner model. So we've got about 50 investment professionals in 17 offices around the world. And each geography has kind of a localized partner that runs that market. So I'm the Canadian partner. I'm based here in Toronto, but I cover the Canadian landscape. And we like to invest as early as possible in the best founders. And we try and get in early, but we're there for our founders. And so we try and invest round to round in kind of a typical life cycle process. And support our founders as they help grow and try and be there for them at every step of the way.
And then you guys have a US team, and you also invested in a YC company in the clean tech space not too long ago as well. So you do both deals on both sides, I take it?
Yeah, I mean, with my background in clean tech, I generally kind of try and add my expertise kind of more globally. So there will be some deals in the US that I will look at. And work closely with our US team there.
Awesome. Adam, so how did you come up with the idea for Ledn? Like, how do you know, this is a thing and I'm going to go all in?
Yeah, so as Alex mentioned, we met in the energy space. So I was investing in renewable power projects on behalf of a large asset management company called Dream in Toronto, and looking at a lot of infrastructure style projects and really seeing institutions try to get into these, and kind of coming from the early stages when I first graduated in 2008, and where it was mostly solar and wind was mostly funded by high net worth, to the Manulifes and pension funds of the world wanting to get into it. And a good friend of mine, Mauricio, who co-founded Ledn with me, he grew up in Venezuela, and that's important to the story because Venezuelans, through the economic turmoil that's happened there, stumbled upon Bitcoin pretty early on because of some economic opportunity that really was available in Bitcoin mining. And so Mauricio was coming back to Toronto, and he was back and forth between Toronto and Canada and Venezuela. And I was his friend that was lucky enough to be connected with the energy sector, which he needed to continue Bitcoin mining in Canada. So we decided to do something together. And then the challenge you run into with mining Bitcoin is you're getting paid in Bitcoin as your revenue, but your expenses are still in dollars. So you're always trying to figure out when to time it. And so it was actually, you have to credit Mauricio with the idea of introducing lending. And then I kind of thought, if we could structure something that bridged the demand for yield with the demand for borrowing, we'd have something pretty exciting. And so we decided to launch Canada's first Bitcoin-backed loan in 2018, and fundraise and grow a team. And so we were about 6 people in 2018, and now we're 52. So it's been a quick 3 years.
That's incredible growth in a fantastic space. And you guys, I think it's great to have that relationship, and relationships matter more than anything else, especially when you're doing this long partnership, right? But the market is absolutely bonkers right now. And maybe Alex, I would love to get these competing perspectives. Founder, VC, how should founders think about fundraising and valuations in this environment?
Yeah, it's a good question. I mean, I think it's definitely a great time to be a founder, to be honest. In fact, we're seeing a lot of employees and operators from unicorns choose to go into, start other companies now instead of become investors. I think that's kind of the signal of where we are in the market. I think, in terms of just how, why to start a company, I think there's obviously upside, but I think there's a lot of capital in the market. Capital is a commodity. But I think investors are still looking for the right mix of kind of founder market fit, the right category that's seeing a lot of interest, and kind of profitable business models. And so while there's a lot of capital and the market is bonkers and it's a great time to be a founder, I still think investors are still looking for some of the key things that make a good business.
Definitely. And then Adam, how did you navigate it? Because you raised last year, right? The 30 million. And maybe you might be thinking of a B or whatever, but what's your advice to founders trying to navigate fundraising in this market?
Yeah, I mean, just to kind of go through the last couple of years, it's been completely night and day from where we started. And I think twofold. I think once you have credible investors like GFC behind you, which Ledn is lucky enough to have, things change because a quality investor has validated your business. And the other thing for us is we were in a unique market. So investor perception of Bitcoin in 2018 after the 2017 hype was quite different when we were first going out compared to what we're seeing now. So I almost kind of describe fundraising a little bit like surfing and starting a business overall. Is like you kind of have to put your board in the water. You have to pick a board. It doesn't have to be perfect, but you just have to get out there, and you have to work hard and kind of get in the right place. But then if you're out there and the right storm comes upon you, things can happen really quickly. And I think, you have to be careful about kind of what brand you put on your surfboard really early on. And that can play a difference about what sponsorships you gather next. So I think there's like an interesting piece, and then things can grow. So I think it's really about just getting started. But the decisions we made early on and the first investors that we chose to work with have had an incredible impact on where we are today, just through that validation and advice that we got, and really partnerships. So that's kind of taking it from there to now.
And then I guess from a market standpoint or industry standpoint, I mean, fintech's really, really hot, right? Should everyone think about adding a fintech angle to ride the wave, or how do you guys think about it?
I mean, as a non-technical investor with kind of more of a finance and ops background, fintech is definitely a major theme within my portfolio, and I think fintech also encompasses a lot of different kind of subcategories as well, from Web 3.0 through kind of payments, but also e-commerce, right, and even kind of deliveries to some extent, which we're seeing kind of the quick commerce trend. So I think fintech businesses and models have definitely shown to scale, and they have huge markets. And Canada actually is kind of, that's one category where Canada has created excellent founders. We have great kind of financial infrastructure here and a regulatory environment. And we've kind of proven as a country to create great talent in that category. So we're generally very bullish on that category here in Canada.
Definitely. And how does one think about valuations, right? Because you guys are investing super early, and then even in an A round. How should people think about valuations? The two most common questions we get is, how do I think about valuations? And then the second thing is, what are the metrics do I need for the seed, Series A, et cetera? So we'll take the metrics one later, but valuations.
Yeah, for sure. I mean, definitely seen a trend from being more metrics driven generally to more dilution and kind of founder driven. And what we're seeing in the market right now, and again, there's kind of no right answer, but just as kind of general guidelines and as an observation, what we're seeing is, a lot of founders are raising kind of family and friends rounds, which is fairly typical. And then, they might raise like a pre-seed round, and we're seeing a lot of pre-seed rounds right now, somewhere between like 500,000 and 1.5 million would be a pretty large pre-seed round, more like 500 to a million. And then I'd say like at the seed, we're seeing a lot of seed rounds being kind of between, the 1.5 and 5, but we've seen seed rounds as big as like 6 or 7 as well, right? US dollars even. So we're seeing some pretty large seed rounds. And I would say the biggest observation I've made in this space is that seed and to some extent even Series A are being more price based on kind of a triangulation between the amount the founder wants to raise, how much dilution they're willing to give up, and then investor demand and their ability to kind of build that relationship with multiple investors to maybe create a bit of FOMO or demand for their round. So I think that's kind of what we're seeing as the rounds get larger and founders try not to give up more than 20%, and 10 to 20 is pretty normal dilution in a round. You're just seeing valuations get larger. And I think what we're hearing a lot more of is that rounds are more priced for perfection, which means that by the time they get to maybe the A or a B, they do need those metrics that align with like a Series B round. And so it just means that they have more capital up front, and there's probably more risk in the roadmap to get there. And that's kind of, I think, one big trend that's kind of emerged out of the last year or two.
Definitely. Adam, when do you think is the right time to raise for founders, right? Because you can be on this train of always raising or never raising, but like definitely always raising. And what happens is you get this press, right? And then you got hit up by all these VCs trying to preempt or your next round or whatever. And it can be a massive distraction. As a founder, how have you approached it? When is the right time to raise?
Yeah, I mean, things again have changed pretty dramatically. So I think we went from a period where we had to raise. Now we're fortunate to be in a situation that you just touched upon, is like, is it a good time to raise? And we are seeing, kind of preemptive interest right now on a weekly basis of new investors want to set up initial calls and such. And I think we've been thinking hard about, okay, if we did this, what would it change the business and would allow it to meet our goals faster? And we actually we did a fairly small seed that was priced in the middle of last summer. We raised 2.7 million at a $10 million valuation, and then quite quickly after, we had another investor that participated in that round preempt us to raise 30 million at a 230 post valuation, not even 6 months later. So things really happened at a pretty exponential scale, and we really thought about that, and we didn't need the money because we weren't spending it fast enough. We were lucky to be profitable then, but we said, okay, what did we think we were going to get to? What were our metrics by year end? And if we're able to raise at that valuation today, and it really de-risks the business. So if it allows us to do something that we were going to do anyways later now, why not? And as long as we can keep the operations of the business kind of segmented, so it doesn't, there'll always be some distraction, but to the extent you can limit that, very important to do so.
Definitely. And as a founder, like, how do you think about it, right? Like, and maybe Alex can weigh in here. What are the metrics you're looking for at a seed or pre-seed, Series A and Series B? For you, your next round is Series B, but like generally, I know metrics differ from industry to industry, and fintech is super hot right now, or some industries are hotter than others, and maybe it's like demand and supply kind of thing, and FOMO. But generally, is there a rule of thumb? Like, what am I trying to hit in the next 18 months or next? And now it doesn't even feel like 18 months. Everyone used to raise for 18 months, and it feels like you're raising for the next, I don't know, 3 to 6 months. So what are you looking to accomplish in the next little while? How should founders think about it?
Yeah, I mean, just diving into metrics. So we measure our business on assets on platform. So how much Bitcoin and stable coins we have on behalf of clients on the platform. We also look at annualized revenue, and we look at profitability. And then we also look at funded accounts and how quickly we're working through, obviously the classic conversions to funded accounts and actual activity. And I think the further you are along, obviously you have to understand that a lot better and be able to answer that question a lot more precisely and ensure that you've tested it across. I would say, with the competition, those have compressed. So, Series A, we were seeing, I think, 30 to 40 million of ARR, and closer to Series B, call it 70 to 100, as far as progression there. And for us, we're kind of working through what's the right pricing in our model to solve for profitability too, because in a way you can play with that a little bit, right? You can solve for growth, or you can solve for profitability today, especially if you hit profitability quite early in your unit economics. So I like to have a discussion about investors, and I think as soon as you can communicate that in a way you're in control of that, it solidifies the business even further and helps really progress and ensure that you are farther enough along to raise at a higher valuation.
Definitely. Alex, what is your viewpoint on that? What are you, because ultimately, and I don't like to put you on the spot here, but I have to, because VCs sometimes will look at your metrics and be like, you're too early, you're too late. And maybe there's two different startups in different industries that might be too early or too late or just the right time with the same metrics, right? But is there a general rule of thumb for Series C, sort of pre-seed, seed, and Series A company that would be super interesting for you, where you will take the meeting?
Look, I'd say for us, like, we'll invest as early as possible. We've invested in some founders because we believe they were just amazing founders going after the right vision before the company had a deck, before the company incorporated. There are other companies that we looked at that had 3 years of traction, were raising their seed, and we're just later stage, but it took us a few 1 or 2 weeks to get some conviction. We always try and move extremely fast because we want to take as little time from founders as possible so they can kind of get back to building. So it's really a case by case basis in terms of how we look at it. But I'd say, like, higher level, we probably see two types of businesses. There's pre-product market fit and post-product market fit. And pre-PMF, it's really just about finding PMF. It's more about customer feedback. It's about iterating on the product. It's about what the vision is and how the narrative is changing than what your customer acquisition cost is, right? But once you kind of find that PMF, then it becomes much more about, like, how you're acquiring users, what's the cost you're doing that, where's that trending, cohort analysis, and kind of more the later stage metrics that we're looking at with kind of a Ledn for the next round and that kind of thing.
How do you guys classify PMF here? Is it, you said customer feedback, but is it like getting X number of paying customers? Is it high retention? Like, what are some things that are sort of hot buttons for you guys?
Yeah, I mean, it's a great question. And there's like a ton of content out there. And like a lot of different founders have different opinions and kind of like metrics. It is when you find this number, that kind of thing. I think I look at it a lot kind of more simply. It's really just like when you feel that shift from pushing to pulling, right? Is the market, is your customer really just pulling you along? And to the point where you feel like you're drinking through a fire hose because the business is scaling kind of beyond what you thought. It's kind of when that transition happens that I think founders kind of feel it. Like everyone says, like, when you found it. And I think that's kind of very true.
Definitely. That question applies to Adam, right? Like, when did you feel you had product market fit? Like, was it a gut feeling? Was it high retention? Was it some specific number? Like, as a founder, when did you feel that?
Yeah, it's been definitely over the last 18 months. I mean, and a lot of it is market driven, admittedly, right? So we build products to help people save more in digital assets, and the interest in digital assets just exploded over the last 18 months. So we have a product that allows people to collateralize their Bitcoin, borrow dollars against it. So very helpful in a market where the Bitcoin price is rising, and another product allows people to earn interest on their Bitcoin and therefore earn more Bitcoin. And so having these products in a market that really exploded over the last 18 months was very beneficial. And just seeing our assets on platform go from 30 million to over 1.5 billion today in under a year really exemplified that.
Definitely. For your next round, or like companies trying to raise the A or a B, there's this concept of back in the day, let's say SaaS, triple, double, triple. So you sort of do that jump year over year, triple, and then double. Is that a thing? Is that how easy is that? I mean, that's hard, right? Like not every company is gonna go 3x and 3x and then 2x. And if you do that, you can be $1 billion company. But what is your take on that, Alex?
It's funny you say that. I don't think I've heard that in like 3 or 4 years. So maybe that's a sign it's not so much a thing anymore. I think one thing COVID's done in 2 years is really compress timelines. You mentioned at the start, like we've seen companies raise money, not every 12 to 18 months, but every 6 to 9 months. And I've heard a few investors say, if you're not getting preempted, then it's a sign that, you're not one of the hot companies. Which is true and also not true. There's lots of great companies not getting preempted as well. But I think people are starting to measure success in this kind of high pace or fast paced market based on kind of quarter over quarter growth or year over year growth. And in some cases, even like month over month or week over week. And I think it's just because everything, people don't have to meet in person to have as many investor calls, so they can spend more time building and less time raising. There's a lot of capital, so founders are raising money faster. And there's just a lot of kind of like macro factors that are at play here that are accelerating the speed at which these companies are growing. And to some extent, a lot of people are saying we're in the golden age of venture right now for that reason.
Definitely. There's lots of money in the market. Folks like Tiger, who are not traditionally venture investors, hedge funds are coming in and writing checks and doing that en masse. So yeah, there's a lot of I don't know if you call it frothiness, but there's a lot of money, interest rates are low, etc. I think also you're right. It's the year of the mom, month over month growth. How many months or quarters do you think of sustained growth you need to show to raise the next round? It feels like people are raising it every 2 quarters, 3 quarters. But is that, how do you think about that?
Yeah, I don't think there's a hard and fast rule. I don't think someone will say, if you had 20% month over month for 3 months, then we shall invest. I think it's more about kind of looking at the whole picture of the business. There's some companies that are seeing 20% month over month growth and at 5-6 million ARR, which is exceptional. We would call that top tier to be able to do that. And to some extent, there's the saying, money is free when you're 20% month over month growth. Which is somewhat true. But I also think investors are looking for kind of a great team and sustainable kind of foundation upon which a bigger round can kind of fuel the next stage of efficient growth. And so I think there are definitely still elements like that investors are looking for. It's not just about growth, it's about a lot of different factors.
Definitely. Now, a question for Adam, because he may or may not have spoken to just you, right, as a part of the fundraise process. So how did you walk us how you approached your round of funding? What did the process look like, prep, timing, etc.? Tell us more.
Yeah, so our first VC round was done with White Star Capital, their new digital asset fund. They led our seed round, and from there, I got, obviously knew Alex from our prior careers as well, and so was able to work with Alex to form a syndicate for the seed, and then kind of follow on to that. But I think it was the first round admittedly was hard, right? So we didn't have established venture on our cap table. We had primarily friends, family, and other angel money before that. So it was very deep, due diligence process. Again, we were in a different market condition even then for the digital asset space. Not even just a little over, as I said, 18 months ago. So it was very much a deep dive into all different aspects of the business, and very much us selling them. And then I think, really things changed because you have a lot of investors wanting to come into this space now. So giving them exposure is something that's very important. But I think what we thought about a lot that doesn't get spoken about enough is governance. And so everyone solves for valuation, but are you able to run the company effectively when there's tough times? How are decisions made is in my opinion, maybe even more important. Obviously, just within some degree of variation, because you have to kind of work through different scenarios and figure out how are things going to develop, and who needs to say yes to get something done in the future. And so I think, I always think agreements are not for agreeing. Agreements are for when you disagree, and how those disputes get resolved. So just kind of thinking through that is something that we thought a lot about. And I think that, gets down to working with people that you trust, and equally that trust you. And so I think if you have that formation of trust, and I think that's why it takes so long initially as well, because the whole adage that you are getting married is very true. It's we have never raised. I've had lots of calls that we've spoken to an investor. They have never invested, especially more established VCs that next week. It's always someone that we touch base with, 6 months to a year beforehand, that's followed our story, gotten to know us, validated not through us even directly, but through others that are connected to us to ensure they feel comfortable, and then they come in. So I think it is that courtship that's very important, and that consistency in building that relationship.
Awesome. I think deferring perspectives here would be great, right? A lot of people say get warm intros, talk to people before you need the money. And then others say cold email works perfectly fine, like Jason Lemkin at SaaStr, who I'm a big fan of, and actually sporting the SaaStr t-shirt today. But he has done a few deals, including TalkDesk, via cold email. So what is the best way to build relationships with investors and get connected with them? Maybe Alex, your perspective, and then Adam.
Yeah, for sure. I mean, we're huge fans of kind of network. Like there's the old adage, like, you are worth what your network, or something like that. But I think we like founders that show a lot of hustle. And I think you don't have to know everybody. You don't have to have a massive network. But if you know a few people, and you can ask those few people who they know, who might know someone that you're trying to get in touch with, I think warm intros are by far the best way to get in touch with investors. And so we're a huge fan of that. And if there's someone that sends me an intro and recommends that I have a chat with a founder, I almost always take the intro, unless it's clearly not a fit, in which case I'll give them that feedback for whatever reason. So I'm a huge fan of kind of network and warm intros as the best way to get in touch.
And how, I guess, Adam, how many investors did you talk to before you raised your 30 million Series A? And how did you go about getting a hold of them or building relationships with them before you even needed the money?
Yeah, I'd say we spoke to 40 different investors, and 8 participated at a significant level, and we had some angels kind of follow on as well. But that was the kind of ratio, and most of those investors came through existing investor introductions, or just exactly, networking through that level. Introductions of others that were either in other portfolio companies together, if that would be value add. And then the other thing that we're lucky to have in the digital asset space is it's fairly collaborative. We did get a lot of introductions through other partner companies that we work with, other trading or lending partners that we deal with on a daily basis, who want to see us successful as their partner as well. So it's nice to be in a collaborative space.
So you did first conversations with 40 or so people. You got a number of warm intros. How did you whittle that down, right? Like, was it like a process where week 1 I went over my deck, and week 2 I sent the data, and week 3 I answered some questions, and week 4, I mean, was it that perfect, or how did you boil it down?
Ideally, yes, and that's the biggest advice I would give and try to give myself every time we go into new rounds is the more you can work with consistent information and try to run a structured process, the better, because it'll be far easier on your team, especially as you're working through this, to try to say, okay, I'm going out with this set of information. It's updated at this date. Here's the financial model I'm using. Here's the deck I'm using, and then try to structure that in as tight of timeline as possible. Obviously, that doesn't always work perfectly with 40 different schedules, coming up with different calls, but it's important. Or else you'll put strain on everyone and you'll frankly confuse investors, because everyone does talk. And if you're saying your X revenue and then 3 months later your Y revenue and this changed and why did that change? So consistency again is everything to getting it done. So just working through a structured process when you can.
Definitely. Alex, from your perspective, you work with some of the best founders. What do the best founders do? How do they run their process?
Yeah, I'd say they run it really kind of thoughtfully, pragmatically, and fast. And I think, it's not about opening and closing around in a week. It doesn't happen with cold conversations. I think what the best founders do is they keep a high bar for investors that are the right fit. They look to their existing investors or friends or founder friends for warm intros. And then so they don't get kind of distracted by kind of overwhelming investor interest, like before raising a round. I see a lot of founders kind of setting kind of a fixed amount of time. Maybe that's 1 hour a week, or maybe like 2 or 3 30-minute calls a week to talk to investors, and kind of limit themselves to that. And that way they kind of don't get overwhelmed. And so I see that a lot. And so by the time it does come to raise, they've already spent, a couple quarters or a couple months building those relationships, just keeping investors up to date, and kind of picking the 4 or 5 kind of like key metrics that you want to update your investors on a recurring basis, I think is smart.
That's great advice. And we were talking. I'm advising a number of startups here, and I've seen this, like bringing people along at the same time with consistent information works really well, because then you sort of talk to people, keep them updated, and then you're like, okay, hey, we're deciding to raise. These are our metrics. You go through the deck, then the data, then answer the questions and get to a term sheet. It's never that perfect, but I think both sides are willing to move quicker than normal in these markets. It doesn't have to be a week, but it's also not months nowadays, right?
Yeah, we're not seeing much more than, frankly, a deck with a good narrative, and maybe at a later stage, like an A or B, like a financial model. But I'd say, I've looked at very few financial models at the very early stage. I focus more kind of on the founders, their background, references are really important. The deck, the narrative, and a product demo.
Definitely. That's the other question I had was, how should you think about decks at different stages? Is it more vision, founder story, focused, and at what stage, right? So what does your deck look like at a seed and series A versus a B?
Yeah, maybe I'll answer the early stage, and then I'll pass to Adam to kind of comment on the later stage deck, because that's something he's been spending time on. But at the early stage, I think it's definitely about the founders. There's not much that exists. Maybe there's a great product, but really it's about the people. So it always drives me crazy when seed decks don't include a founder slide or founder information. I think that should be some of the most important information put up front, personally. I love to see kind of information on just the market opportunity, the solution, pretty standard stuff. And the solution, kind of a demo or an MVP. I'm a big fan of when founders do their demo, maybe on a Loom or a pre-recorded kind of demo. It's kind of, it can save time, and it can also make for a very kind of slick pitch when a founder is able to show a screen share of their Loom demo while being able to talk over it on an investor call. That kind of shows kind of high, let's say, intellectual velocity of a founder to be able to present in that way. So we're big fans of that. And then really just the vision. What do they want the business to be in 5 to 10 years? And what's the model? How are they going to get there? Those are maybe 4 or 5 of the key things that we'll look for at the early stage.
Really awesome. And Adam, you're likely thinking about a B in the near future, or even at your A. How are you positioning your deck right now? How heavy is it on vision versus metrics? Like, what does that look like?
Yeah, I think there's an opportunity. I mean, so we talked about metrics earlier, and there's been a few situations where we've been able to kind of turn the conversation around because I think, really investors are looking at many different types of companies and trying to as quickly as they can understand the business. So I think we've really used try to convey what's important to us and what are we excited about, right? And really trying to show more and more that we do understand the client journey. That I think is important regardless on how early you are, how late, how well do you understand your customer. And I think as you get later, how sticky it is, right? Like, that it's working now. And you've gone from having 0 customers to now thousands or hopefully millions of customers. But how do you know they're going to stay around? How proven is the long-term value that you're getting from them? And what else can you do to complement the business as you grow? How do you keep people excited about it? So you're going from, is this going to work? Are you going to survive, to why is this going to be the next new and exciting thing to take the next level, right? Because you're not if you're raising out a $200 million value, you're not trying to justify it's worth $200 million. That investor is trying to invest so it's worth $2 billion. So how do you make sure that you convey that it is, a multiple return for them, and you are committed to getting to that level? And then, I think the most common question is, what are you going to do with the money? Why are you taking this money, and how is it going to change your business to get to that level? And you're just kind of wrapping up that. And then you think too, at that level, you can use your existing investors really to prep and to work through that and make sure that it's structured so that you are prepared and you go with something that's really exciting.
Definitely. I think that's some great advice here, and it's all in phases, right? When you're starting a company, I'm just thinking back to when I started. Was phase 1 was just anything possible, elbow sticking out, get a few people paying for it to try it out, and then phase 2 was just make sure these people stay and don't leave us for the next year or so, right? And then you get to the next phase, which is let's figure out one repeatable, scalable channel to keep and grow customers. And now we're at a point where, okay, we've have this one repeatable, scalable channel. Every dollar in it will generate 5 or 3. Now let's spend a third of our time trying to figure out new channels, sort of thing, right? So that makes complete sense. The question here from Bilal is, how big is a good pipeline of investors? 100 seems excessive. 10 may seem low. What do you guys think? Adam, how do you think about it?
I think you have to asterisk that with quality and likely to invest. So we could come up with a list of 1,000, but if we've never spoken to them and if we don't know anything about what they're interested in or what type of round they're going to come into and whether they like the sector. So in the early stages, we learned really quickly to switch the conversation around and try to start the first 5 minutes with, are you interested in leading rounds? What's your size? And so really trying to filter out, are they going to transact? Because I think the other thing is, you have to be careful of, fishing expeditions, right? So investors, these meetings are very valuable for them if they're interested in the sector. So if in our business, we could be speaking to someone that's looking at raising, looking at investing in a similar business, and that's perfectly fine, and you can educate them a lot for free without knowing whether they're going to get there. So I think just being wary of, are they likely to transact, and is this, can I figure out before even I speak to them whether they're a likely candidate to qualify them in a list before you spend the time and effort of working through that is important.
What I'd add there is I don't think enough founders do this, which do the research on the investor market and find out which investors are interested in your category or your business model. I get a lot of founders asking me for introductions to certain investors that just aren't a fit for them. Maybe they're a consumer company or a D2C company, and that VC they're asking for an intro just doesn't do D2C, period. And it's kind of obvious from their website. And so I encourage a lot of founders to kind of, maybe it's an Airtable you put together that you share with your existing investors or your, co-founders or executives to kind of triage and stack rank different investors and, highlight deals that you think are similar to you and kind of prioritize them by which investors you think are the best fit for you, given your sector and stage and business model. And then go out and ask investors or people in your network for introductions to those key investors. And I think once you do that as a founder, you'll realize that list is probably not 100 investors. Maybe it is 10, maybe it's 20. I don't know, it depends on your business, but I think it's good to kind of take that prioritization approach to investor outreach.
Definitely. And I'll add a couple of points here because this is very important. I get hit up a lot because I live in San Francisco and my neighbors are either angels or investors, right? And I get hit up a lot. Make intros. Can you connect me with VCs? Man, I'm also a founder and I'm running a company, running traction. Make it easier on people to make intros, right? So research, come up with a list of investors. It's not hard. There are so many tools. Go to Crunchbase, figure out the list of investors, look at the kind of companies and themes they invest in, and get it to a point where find the partner that you want to connect with. It's like it is sales. Raising money is sales. Pitching to PR is sales. It's all sales. When you try to sell to a customer, you don't blanket blast thousands of people. That ends up in spam. Figure out the 50 people you want to connect with. Who are the partners? Where do they eat, breathe, drink, sleep? Who are they connected with? What kind of projects they're passionate about? Build that list and then ask for intros, right? And it makes it easy. And then when you ask for intros, don't say, make me the intro to these two partners. This is why I think that'd be a good fit. And give the person making the intro affordable blurb like, hey, this is what the company does. This is their traction. This is why it's exciting and fits in with your theme. So it's very easy for me or Alex or Adam to forward, right? If we have the relationship.
Yeah, and I would say like if I'm getting an inbound from a founder, I'm going to give that inbound a lot more credibility if I know that they've gone to the effort to say, hey, Alex, I know you've invested in Ledn and Coco NFT, which are two consumer crypto plays in Canada. I'm in that same category, but doing this differently. Would love to chat. I think that's much more compelling to me than just a cold intro. Hey, I'm raising money, please invest.
Definitely.
Absolutely.
And what I'm seeing actually a lot of startups do is they build a list of 40 or 50 people, and they sort of, when they pitch, and I don't know if this is a hack or if this is recommended or not, that they sort of start pitching to investors they don't want money from in the beginning, just to get the practice, because eventually you get the same questions anyway. So your friend, and then they go down that path of building relationships. But they start with, I've seen a lot of startups now recently start with the list of 40 or so, and then bring it down to 10 or so as they go along, kind of thing. Is there a rule of thumb there, Adam or Alex, that you guys have seen?
I think that's an interesting idea to practice. I would say be careful about that. I think you never know how relationships are going to develop and who you'll need later. So I'd say try to treat people fairly along the way. So on that I would try to use your existing investor base, who's probably even more honest and bought in to that versus new investors. But it will obviously depends on what round you're at, or a connection that you may have to someone that works that may not invest but would give you honest feedback. But yeah, interesting idea.
Definitely. Now, Alex, like I guess, or rather Adam, question for you here. How should founders allocate their time between product and fundraising and whatnot? How do you spend your time? Like Alex brought up earlier that when you're not raising, spend an hour or so a week talking to investors. Adam, is that what you do?
Yeah, so we divide it up. So Mauricio and I, who's the other co-founder of Ledn, he spends a lot of his time speaking to clients and doing a lot of new product development. And I spend more time with investors and more on the operation side of the business as of lately. And then we take a lot of investor calls together, but I do a lot of the prep behind the scenes and keep us kind of organized in that respect. So I think it's kind of really deciding early on with not just founders, because I like to think we really have a founding team. Mauricio and I came up with the initial idea, but there's been many along the way that have contributed massively to Ledn. So it's kind of like figuring out everyone. How do you keep everyone doing what they're best at and staying organized?
Definitely.
I'd add to that. Like I think a lot of the information that investors want is also information that companies and senior leadership should have and be very organized about. Like founders should have a very clear narrative and always be thinking about how to iterate on their narrative for their own purposes of leadership and for their team. And same thing with metrics and unit economics, which are things investors are going to ask for, but you should also have a good handle as you get past the seat on kind of your Unity Con and things like that. And so a lot of these things are things that you should be tracking anyways. And so what I often encourage founders to do is track them for yourself first and for your team first. And then what you share with investors, however often you're comfortable with, whether that's an hour or longer or shorter, should just be kind of like the high level takeaway from that and what you think they're interested in, and kind of keeping it concise, I would say.
Yeah, and there's a great point there, right? Focus on building a business and a product that customers love and want to pay for. Your narrative, the job of a leader is to build, inspire, and motivate a team to deliver. And deliver is the lagging indicator. And as a part of doing that, communication is massive, right? It's huge. It's important to communicate the vision, to inspire people day in, day out with numbers, with stories. And if you do that as a leadership team, you have alignment. And then it's very easy to put together the deck because you've said that story a number of times versus, you're like just putting this deck to please an investor, right?
Yeah, that's absolutely it. And I think if an investor is asking you to do work that isn't valuable to the business, I think what's missing is that, like, having the confidence to go and work with the investor to actually say, okay, you're asking for this, but this is the way I look at this, and are you excited about this? Because I'm more excited about this metric than this one, and this is how I think about it. And really having that conversation, because you shouldn't be chasing things. There shouldn't be a misalignment there, right? Or else you're going to be going two different ways, and you're going to be building for two different targets. So just kind of working through that, and then yeah, I think you're absolutely right, Lloyd. You have to be. If you're not excited about things as the leadership of the company, how do you get a team behind you to be excited and inspired about it? That's so key.
Definitely. And the other thing, June also asked the question about grow the product versus raise money, and Adam touched on dividing and conquering. I think as a founder or a CEO, you have three jobs, and the top three jobs, or those three jobs, all involve communicating, articulating your vision, right? You're hiring, you're evangelizing, and you're fundraising. You're doing that. And the thing is, they all can be the same thing, because when you're hiring, you're conveying your vision. When you're talking to the press, you're conveying your vision, and you're sharing some high level numbers, and you may pare it up or down depending on whether you're hiring or talking to the press or fundraising. And then you get on this journey where you're doing it more and more, and it becomes second nature the more you talk to, right? So Jeff Lawson is a perfect example. Several months ago, I interviewed him, and he's a developer today, almost $100 million company. And he never spoke that well in the early days, but today he's one of the best tech entrepreneurs, who are best speakers from the tech entrepreneur landscape here. Phenomenal speaker. And he said, I just kept doing that, like articulating my vision and the metrics to the team and communicating that often and often and often and often. And then it just become natural, right? So I think there's a lot of truth there. Question for you, Adam. What's the most valuable thing or set of things a VC has done for you, and what's the worst thing?
I would say 100% pushed me to think bigger. I definitely can credit Alex with this. Is just really inspirational about encouraging to think how do we do this faster? How do we do it better? How do we really help unlock friction points for you? Really, yeah, just that grant, that big vision of where you're going. Because I think it starts there. Building that confidence and then being able to convey it to the rest of the team. The other thing I thought I would just touch on, because I was thinking about that as you're saying with hiring. I think it's going to become a bigger piece of investor discussions when there's this disconnect right now that there is a lot of capital and there's a massive shortage for quality talent. And I think as you scale companies, the conversation about how are you attracting but then retaining talent is going to be so much more important, because I think that you see this a lot, right? You see this culture disruption as companies grow, that they hit this level, they're doing really well, and then things start to get misaligned and people are leaving. So how do you really go from where Ledn's at, where we're at 50 people today, to 500 people without disrupting that culture and making sure you can grow and sustain that and really scale that. So I think that's going to be part of it. Not just how do you keep your customers sticky, but how do you keep the operation side of the business sticky.
Definitely. And Alex, what are some great things investors can do for founders, and what have you seen that are some non-helpful things inadvertently investors end up doing?
Yeah, for sure. I mean, I think my approach is really to be hands-on as a founder, but more there for the founder and let the founder kind of drive the level of involvement. I always let my founders know I like to provide value in kind of 3 core areas outside of just being there as a sounding board and capital. And those 3 areas are really around kind of introductions. And so, that's investor introductions and kind of advice on fundraising strategy, hiring introductions to help with finding great talent. And then also just kind of partnerships and customers, right? And so helping with the top line. And so those are really kind of the 3 areas I like to kind of help, but I'm not there. And where I've seen a lot of founders or investors kind of go wrong and founders provide me negative feedback is investors who try and take too much of an operating role. And they're kind of hounding the founders every day, almost trying to add value, but going too far and asking the founders for things on a daily basis and creating work for the founders. But they're not actually in the business. And so that's something that we definitely don't do, but what we've heard some investors do. And I think it's smart to just kind of, be there for founders, but not take away from the business. You're there really as an investor. You're not an employee, so to speak. And our job as investors is really to enable our founders and our companies and their teams to build the best business possible and be there to help them avoid pitfalls.
Definitely. And I couldn't agree more. We, after our Series A as a bootstrap company, we attracted incredible talent. Growing from 30 to 100 plus people in a short amount of time is not easy. And our exec team, we didn't even use any recruiters. Our CTO came from Avalara, $13 billion sales tax software company. Our CMO has come from 4 exits, 1 IPO. One of our board members just sold a company for $1 billion, and she was an SVP at Intuit, Lori Schulz. All of this was evangelized by our investors and board. And they can give you such firepower when you're doing 2 things, or 3 things rather: talking to customers, talking to solid candidates at the high level, and then the social proof, connecting you with other investors for your next round, right? Because investors talk to each other. So that is some fantastic advice there. One piece of unconventional advice that founders don't utilize enough, and maybe Alex and then Adam.
Man, that's a tricky one. Unconventional advice. I feel like there's so much advice that's out there in the market. But I mean, I don't know how unconventional this is, but I think, as I said earlier, this is a market. This is a founder-friendly market. This is a great market to be a founder. I think now's a great time to start a company, and I would just encourage people to think really big, and especially Canadian founders specifically, think beyond Canada, to think about global businesses. And I think there's another question, Lloyd, you've asked me this before, but like, what can first-time founders do that don't have that pedigree to kind of set themselves up to raise VC? And I think some of the best things early founders can do is go work at a venture-backed company or go work at big tech before they go start their own business, and gain operational experience. Learn how it's done. Learn how a VC business works. Learn how to grow. Kind of build your playbooks, and then take those playbooks to go start your own company. I think there's a lot of people just getting right into it. Doesn't mean they can't do it. They just may have a little bit more learning, a little bit more time, needs a little bit more capital along the way. And so that maybe that's some of the advice that I would give is benefit from some of the great companies we have by going to work for them and then going to your own business.
Adam, how about yourself? Unconventional advice, or advice that, you thought maybe I should have taken this, but I just ignored it.
Yeah, I'd say that, hopefully this isn't too unconventional, because hopefully, other founders are doing it, but it's just, talking and asking for feedback on how you're doing personally from everyone in the team, regardless of whether they just started at the company, and just communicating a lot and just being open to honest feedback with that. I'd say what I've learned a lot, especially in this remote work environment, is that context can become missing so quickly. So as you're trying to grow really quickly, do people really understand understand the direction that you're going. And so this is more less, investor founder advice, but more just, operations advice and growing. And what I've noticed from scaling the team over the last 18 months, especially, is, do people feel aligned, right? So what I found is I was spending so much time speaking to investors about where we're going and what our roadmap is. I realized about a month ago that I wasn't doing that enough with the team itself. So just, am I articulating the vision as clearly back to, are you being inspirational? So that same vision that you're articulating investors has to be communicated even more so internally, and just making sure everyone understands that. So we were able to just have that open dialogue. So I think you can never really over communicate. I think it is what I've learned is, people aren't, they'll let you know if you're doing it, but it's hard to, people won't tell you if you're not. So don't be afraid to talk, and whether it's investors or your own team, talk to people too much. Touching base on a daily, weekly basis is everything. And we are a lot closer to our investors that we speak to, of course, every week. So just keeping that open text, friendly, touch points.
Awesome. And, I think everything is communication, right? If you can't inspire and motivate people, then there's going to be a lot of misalignment, and you'll see it in people's actions. They may not ask you, explain this to me, or come and inspire me, but you'll just see that in their actions, because ultimately excited, inspired, and motivated people can move mountains. And if you want to build something big, you need to convey that and help them realize what is the end impact of this. How can we get in touch with you guys? Alex, I know a number of founders want to reach out to you. What's the best way to get in touch with you? Are you on social? What is it?
I'm on, I probably use LinkedIn the most. I'm a little bit on Twitter, email, but I'd say, probably follow some of my earlier advice, which is try and find a warm intro, try and, see who the mutual connections are, and maybe ask some of those connections for introductions. That would be the best way.
Awesome. And Adam, are you active on any social channels?
Yeah, LinkedIn and Twitter. So my Twitter handle is easy. My full name, Adam Reeds.
Awesome. Thanks so much, guys. This is some great advice and personal stories from two friends and who've known each other, and you've invested and all of that. So I enjoyed the conversation greatly. Wishing you guys great success. And Alex, hopefully I get to co-invest in some of your companies too.
Yeah, for sure. Let's do it.
Awesome. Love and peace, guys. Have a good one.
All right, thanks.